3 numbers that we believe all real estate investors need to know today on the 1031 Show. I'm Alex Stavorowski, and over the last few years, we've talked with thousands of real estate investors about the exact problems that we'll be discussing on today's show. The first number we think you need to know as a real estate investor is about your return on equity. And obviously, this is going to be a lot of numbers and a lot of different calculations that come into this. But the bottom line is that your return on equity drives performance of the property and whether or not we think it's a viable investment. For a return on equity, the equation can be as simple as net income divided by the total equity that you have in an investment. But the deeper we get into it, there are some hard numbers you need to know, as well as the tax side of things that can really impact how well a property might be performing based on this metric. For a return on equity, looking at the hard numbers, you'd start with something like how much are you generating in rental income each month? Then you'd start subtracting out your monthly expenses. And don't forget about your annual expenses that might only be charged once a year, like your taxes and insurance, but that also factors out. So you can look at it both on a monthly and an annualized level, but building out a net return on equity helps you to understand how well might the property be performing. Beyond that, you have to factor in the taxes. So your tax bracket of that income that's being received then works with numbers like your depreciation and how much of those expenses can be used to write off the income that you're generating from a property. So at the end of the day, what is your net after-tax income and your return on equity? There are a number of pitfalls that we see people fall into when they start to track these numbers. Again, on an ongoing basis, there may be things that track monthly, maybe things that track annually, and some that aren't going to show up as hard numbers or cash in the bank. So a good example would be depreciation. This is showing up on your tax return as an expense write-off against income that you've had from a property. But if you're not taking it and not reflecting that on your tax return, the IRS still deems this as being taken in that asset as depreciating. So whether or not you're using the depreciation to your benefit, the IRS still will show that it is a depreciating asset over time. So a pitfall to avoid is with your depreciation, making sure that that is being taken on your tax return year over year so that you can benefit from it and not just have the depreciation recapture become an issue down the road when you thought you haven't taken depreciation at all. For depreciation itself, the IRS has determined that your asset has a specific lifespan. And over that lifespan, each year, a certain value of that is reduced. Now, the IRS does give you the benefit of using that reduction in the value of your asset to offset things like your taxable income, but you have to make sure that it's being reflected on your return. So depreciation is the reduction of the value of your asset, like a rental property, over time, but making sure that you're using that to your benefit is going to be a key piece of a return on equity that we like to see from any real estate investor. So beyond the tax numbers and things that we look at for a lot of the analysis we do when we're helping people with their investment real estate are the factors like your ongoing expenses or the things that may not be recurring but crop up once and, well, you forgot to write it down. And that can become a significant problem the more properties that you have in a portfolio and the more actively you are managing something, things fall through the cracks. So when you're trying to calculate a true return on equity, making sure all of those factors like your expenses are being taken into account is very important. Making sure that you account for things like vacancies in properties where over a year-to-year basis, if your property isn't rented out 365 days and you have a turnover in a lease and now it's been 2 months since there's been a renter in there, that's going to impact your metric like return on equity because that's not income you're generating while that property's vacant. So we can look at it on both the general level of a property over time and the return that you've had from equity, but also on a more specific level year to year, calculating analysis for return on equity based on the actual performance of a property within the last 12 months. When it comes to your expenses themselves, there are different ways that those can be tracked. They can either be tracked to offset current income as a capital expense year over year, showing that if you put money into buying a new water heater, then you can write that off against current income that's being generated. Or for specific improvements done to a property, a capital improvement will improve your overall basis in the property. So back to the question of how do things like depreciation and improvements to your property affect the value? Well, that's an ongoing number that you have to track and one that we think is very important to be aware of especially when you're coming up on questions like, should I sell the property? Should I do a 1031 exchange? What might my tax liability be? And how can I figure out those numbers to decide what I should do next? It's not uncommon for me to be talking with a real estate investor who has probably been in this space for decades. They've been working with their rental properties, building the portfolio up over time, but when we start to ask specific questions like, what kind of net income are you generating? If they're not dialed into the month-to-month ongoing bookkeeping nature of their properties, they might not know. And unfortunately, it's very common. A lot of people, even with 2 or 3 properties, someone I was talking to just a couple weeks ago was telling me that he spends so much time dealing with the properties that he kind of loses time to track the expenses that he's spending. And then it comes down to one day a year that he's trying to aggregate all the money that he spent between different hardware stores and online and all of these receipts, and it takes up an excessive amount of his time because he doesn't do it and doesn't have time to do it on an ongoing basis. And admittedly, things fall through the cracks, and he wasn't quite sure, how do I make up for some of these different losses or expenses that I've been putting into these properties? How do I know how efficient I'm being? So when we're looking at something like return on equity, it's not as simple as how much are these properties generating from you when you get a monthly rent check. It's what are you left with? What's in your pocket at the end of the day on a monthly or annual basis that you can spend? Because for most people, these passive forms of real estate investment aren't so passive after all, because they've been spending so much time tracking all of these numbers or not tracking them, and now they're not actually sure how well this investment is performing. And at the end of the day, this real estate is an investment for how these people are operating their lives. When we look at what might be a good return on equity, well, our approach is always purpose, planning, portfolio. And a good return on equity is first driven by what is the purpose of this investment? Is it fulfilling the purpose that you might have originally intended for it? Or even now, as life has changed, is it still working towards that purpose? For somebody that wanted to build up generational wealth 30 years ago when they started into real estate investing, is that still something that they see and have targeted for this property? Or now are they working on the day-to-day so much that they lost sight of what the end goal might be? Well, a return on equity would help them to understand whether this investment property itself is the right investment to be used for that purpose, or if there might be better opportunities out there worth pursuing. After that, we look at the planning aspect of it. If there is something else that's going to be a better opportunity down the road, how do you get there? What are the best ways to do that? What are your options? What are the recommendations? And where can they start to make some improvements in the short term to help achieve those longer term goals? Finally, once we figured out where do you want to go, the portfolio solutions come in to help facilitate making those improvements, making that progress towards your goals. So what is a good return on equity, and what does that look like for you? That answer may change and might not even be related to the number that you determine as a percentage of your net income divided by your total equity. But depending on how much time and effort you want to be spending managing a property or not, then we start to look at a number of other metrics beyond just a return on equity to build out a real understanding of the numbers that you, as a real estate investor, need to know. That brings us to the second number that we believe every real estate investor needs to know. And simply, it is return on effort or return on time. Another way of looking at that is how hard are you working for your passive income? Simple equation is taking your return on equity that we calculated, dividing that by the total number of hours you spend working on any specific property. And it is important to look at these properties on a case-by-case basis because these numbers will vary, and the overall experience of one property to another is an important factor as well. But when we look at a return on effort or return on time, I think of a client I helped last year working through 5 different properties that were being rented out to college students. And he was spending over 20 hours a week dealing with these properties instead of enjoying the retirement that he and his wife had started to live. And he'd gone from one job to working this full-time job as a active real estate owner and manager. And it wasn't something that he had ever intended to do. But when he looked at his return on equity, it was a solid number. It was really profitable for the way he wanted to live his life. But when he started to look at the return on effort and the number of hours that he was spending on a weekly and monthly basis to achieve that return on equity, that's where we started to notice a little bit of a deviation from what he had intended for these properties. Another important consideration when you're looking at just how many hours you're spending on your investment real estate is on the tax side of things. When you can be qualified as an active or passive real estate owner, depending on the amount of hours and effort and time you're putting into a property. And that's something where it's very important to always consult your tax professional. We've had a number of our real estate clients come through our in-house tax and accounting services to help provide that type of advice. But when you're running these numbers like your return on equity and your return on effort, there's always a tax lens that needs to be addressed with any sort of investment real estate. So what does a good return on effort or return on time look like? Well, our approach of purpose, planning, and portfolio would help to illustrate that the purpose behind your time is an invaluable asset, and making sure that that time is maximized for the benefit of how you want to be living that purpose is something where if your real estate is drawing down on 10, 20, 30 hours a month, even that can be more than you would be willing to sacrifice if you had other options available. So if the purpose of your life is not to be managing toilets and tenants and trash, then figuring out what might my options be are some of the things that we talk with our clients about. So when the purpose has been determined for how do you want to spend your time in your life, whether or not you're in retirement, the planning comes into play with the options for how can you move forward to use that time to the best of your ability and the real purpose for what you want to be achieving. So the purpose informs the planning. The planning informs the portfolio solutions that we'll consider to allow you to recapture that time if too much effort is being spent where it doesn't need to be. And again, there is no one right answer for how an investment property should be working for someone. There are benchmarks to be able to compare good versus not so good, but also the most important piece is what do you need this property or this investment to be doing for you? So when we look at your return on effort and your return on time, if you love spending hours and hours at these properties and fixing them up and managing them and dealing with the tenants, that's fine. That's a good use of your time. If you don't, or over time that has changed, then that's where we start to look at this return is not living up to its potential. And your time is much better spent doing other things, and your investment is much better off not taking up that time. So when we look at the different types of ways to own investment real estate, ways to be involved, those are the questions that we start to ask, are not just about knowing the numbers, like the return on equity, like the return on time, but how are those numbers working for you, and does it make sense for the life that you're trying to live with this investment? The last number to focus on is going to be the return on experience, or the return on your life, which takes into account a lot of these numbers that we're talking about today. The return on equity, the return on your time, but the return on the overall experience that this investment is providing for you is a very important number to know, even if it is a little bit harder to quantify. So when we start to look at how can you really understand the return on the investment experience that you've had, then that's a much longer time horizon we need to approach. If you held the property for 10 years, 20 years, it's probably provided a lot to your life in a lot of ways that you might not have even recognized. But the past is not something that we can change, it's something we can learn from. So we look at how can this property now be used to the best of its ability for the life you want to live going forward. Because if the last 20 years have been spent well-intentioned, dealing with these properties on a day-to-day basis or monthly or annual, dealing with the tenants and all of the ongoing maintenance and needs of a property, those are good problems to have. But if they're not serving the purpose that they were once intended to achieve, then the return on your investment and the return on the experience is starting to downgrade. And that's not something that we like to have people deal with for long periods of time. And we talk with the people about what might a different experience provide to their life. The way we approach it is a 1 to 5 scale, where 1 for an investment property, for example, would be my investment property is holding me hostage, as opposed to a 5 is this investment is doing everything I need it to and helping me to achieve my purpose. And now there's obviously a lot of interpretation in between that range, but an idea of, yeah, it could be working better, or no, I think it's okay, but there are a couple things that maybe even down the road are going to get worse that I don't really want to deal with, helps you to understand how the experience of this investment is going to be treated. It's not like a stock, it's not like a bond. It's an investment property that you have active involvement with. And that part of your life is something that's very important, but is it serving the best purpose? And so when we start to, again, compare these numbers, whether it's return on equity, return on time, return on experience, to benchmarks of on the full spectrum of active to passive real estate ownership, if you go as passive as possible, where there's no drawdown on your time and no involvement of your life to deal with this investment compared to the amount of time and energy and effort you're putting in now, how do those numbers compare? And are they acceptable for the kinds of problems that you might have to be dealing with to maintain that active ownership? And there are ranges to all of these things, but the bottom line is that knowing these numbers is the single most important thing a real estate investor can do to decide whether or not their investments are working for them the way they should be. So after we've spent our time talking with these real estate investors about what do these numbers mean and what do they look like for my properties, the next question is, how does this all work together? And what does it mean for me as an owner of this property? Well, the way we like to see it is that if you combine all these different values, you can produce a letter grade, essentially, of how is this individual property working for you. The return on equity, the return on your time, the return on your life experience, those factors combine into what we see as an overall performance of a property. And again, this is going to vary from property to property, and so in our strategic real estate analysis, we provide a per property diagnosis of the performance based on all of these numbers and these factors that go into what might provide that type of return. But at the end of the day, it's knowing not just the numbers themselves, but how does that incorporate into your overall life and investment structure that's going to give you the empowered decision-making ability to move forward or make changes if changes need to be made. So if that sounds like you, if you're somebody that doesn't know the numbers, that their own real estate might be working for or against them, and you want to figure out how do these numbers work together and what kind of return on my life am I actually getting now that I'm actually going to look at this 20 years after I bought my first property, 30 years after I started getting into investment real estate, I need to know these numbers so that the next 20 or 30 years don't look the exact same, because I want to do more with my life and I want to figure out what comes next. So if that's you, click on the link below in our description, schedule a call with me and my team, and we'll discuss all of your real estate needs and go from there. If you want more information like this, you know what to do. We'll see you next time on the 1031 Show.
Impact 1031 is a DBA of Ridgegate Financial, LLC. Not an offer to buy nor a solicitation to sell securities. All investment involves risk. Past performance is not indicative of future results. Speak to your finance and/or tax professional prior to invest. Securities offered through Emerson Equity LLC. Member FINRA SIPC. Only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication. Investment advisory services offered through AE Wealth Management. Emerson Equity, Ridgegate Financial, and AE Wealth Management are not affiliated.